We've seen startups go through a funding process with ease and excitement, but end up thinking they maybe could have bargained a little higher. Then they go through the process of having to choose where or what aspect of their business they should spend the money on. And this can be very stressful. And we've seen the opposite, where it's like they hit a jackpot, then they go on a shopping spree, spending too much money on fancy offices or expanding too quickly, which is also known as founder syndrome. And all of this is most times due to a complete lack of understanding of how they raise the right amount of capital, negotiate higher, or pitch their business better. So here's a complete tutorial on understanding the startup funding process and raising capital.
But it is a business. How's it going to work?
The advice I would give.
Biggest risk you can take is
I can make money much faster than
is
Apple
difficult.
does.
Lesson 1. Understanding the VC funding process. Venture capital, or VC, is a key part of the startup ecosystem, providing the capital that many young companies need to get off the ground. It typically goes through several rounds, each with a different focus. The first round is called the seed round. It's usually the first money a startup receives from outside investors. The goal of the seed round is to prove that the startup has a viable product or service that their customers will be interested in. This fund is typically used to cover early expenses like salaries and office space, as well as research and development. In the next round, Series A, the startup's business model is validated and it is then scaled. Series B and Series C are just focused on continuing to scale the company and build out its team and infrastructure. This is where they work with venture capitalists throughout to negotiate terms and close funding deals. Lesson 2. How to raise the right amount of capital. Not knowing how to raise the right amount of capital can lead to either underfunding or overfunding, which in reality isn't as good as it sounds. What is the right amount of capital to raise? So it's not a one-size-fits-all answer, and the amount of capital needed will obviously vary from startup to startup, but it will depend on several factors, including the stage of the startup's burn rate, the startup's growth plans, the market conditions, and the startup's valuation. If it's a seed stage startup, it will likely need less capital than an early stage startup because it's still in the early stages of development and isn't generating significant revenue yet. On the other hand, an early stage startup may need more capital to expand and grow its customer base. Next, let's talk about burn rate. A startup's burn rate is how much money it's spending each month. So if a startup has a high burn rate, it will need to raise more capital to keep running. If a startup is planning to grow rapidly, it will likely need more capital than a startup that's growing at a slower pace, because the fast-growing startup will need to invest more in marketing, sales, and other areas to support its growth. If investors are interested in funding startups in said industry, it will be easier to raise capital because there will be more investors interested in investing in startups, and they may be willing to offer more promising terms. Let's take the tech industry as an example. During a tech boom, investors may be willing to invest more money in tech startups, and they believe the industry has strong growth potential then. But during a tech bust, most investors wouldn't want to invest in tech startups. So it's important to consider the industry when evaluating the market conditions. Lastly, the startup's valuation. A startup's valuation is the value that investors have placed on the company. A high valuation will make it easier to raise capital because investors will be more likely to invest if they believe the startup is worth a lot of money. However, a low valuation will make it more difficult to raise capital because investors will be less likely to invest in a startup that they don't think is worth much. Lesson 3. Negotiating the right ownership percentages. Don't let investors take advantage of you. You can get the funds your business needs without selling your company. Most startups don't know how to negotiate well enough not to lose ownership or liquidation preferences, and that's why this is a key part of the funding process. When it comes to ownership percentages, investors typically want a certain percentage of the company in exchange for their investment. You need to decide how much equity exactly you're willing to give up in exchange for the capital you need. Liquidation preferences refer to how the investors get paid if the company is sold or goes out of business. You need to understand the different types of liquidation preferences and how they can affect your ownership percentage. But let's take a step back to how much equity to give up. Here's a few factors to consider when making that choice. 1. The stage of your startup and how much capital you need to reach your goals. 2. Your long-term plans for the company. And 3. How much ownership you're comfortable giving up. The more ownership you give up, the less control you have over the company in the future. Now, we've talked about this earlier, so we'll skip the explanations, but what I will go deeper on is number 3. If you're a very early stage startup, you may need to consider giving up a higher percentage of equity than a later stage startup. Why? Because the company is still in the process of validating its business model, and there's a higher risk of failure. So you may need to give up a larger percentage of equity in order to attract investors. A later stage startup, on the other hand, has probably proven its business model and has a lower risk of failure. Knowing this will give you a good grasp of the trade-offs involved. On the one hand, you may need to give up a significant amount of ownership in order to raise the capital you need. On the other hand, you'll be giving up control and future profits if your company is successful. I know it can be a difficult decision, and there's no one right answer, but you need to weigh the pros and cons and decide what's best for your company's long-term success, even if it means rejecting some offers. Lesson 4. Writing a pitch that wows potential investors. We've seen cases where startups were not able to effectively pitch their business to potential investors, which basically means they bored their investors and lowered their valuations. That's why it's important for you to have a well-crafted pitch deck and business plan you can present to potential investors. In general, modern investors are looking for pitches that are concise, data-driven, and focused on solving a specific problem. They also want to see a clear plan for execution with a specific strategy for reaching your target market. It's also important to be authentic and honest in your pitch and to show your passion for the problem you're solving. Investors want to see that you're committed to your idea and that you have the drive to make it succeed. Let's start with the structure of your pitch. Your pitch should include sections like the problem you're solving, the solution your startup provides, the market opportunity and competitive landscape, your team and how you plan to execute your vision, and the financials and how you plan to use the investment. Let's start with the problem you're solving. This is the most important part of the pitch. It explains why your startup is necessary and how it will make a difference. For example, let's say you're pitching a new ride-sharing app. Let's call it WeDrive. You might start your pitch by describing the problem of traffic congestion and the time and money wasted by commuters. Then you could explain how your app solves this problem by making it easier to share rides and reduce the number of cars on the road. Next, let's talk about the solution your startup provides. This is where you explain how your product or service works and how it will address the problem you identified. For a ride-sharing example, you might explain how the app connects drivers and riders, how it handles payments, and how it provides safety features. The key here is to be clear and concise, while also demonstrating how your solution is unique and better than any existing alternatives. Okay, next we have the market opportunity and competitive landscape. This section is important because it shows that there's a need for your product or service and that there's a market for it. You want to provide market size estimates and explain how you reach your target market. You should also discuss your competition and how you plan to differentiate yourself from them. For our app, you might explain the size of the ride-sharing market and how your app will compete with existing services like Uber and Lyft. Alright, let's move on to the team and execution. In this section, you introduce your team members and explain their roles and responsibilities. You might describe the backgrounds of your team members and how their experience will help you succeed. You should also explain how you plan to execute your vision, including your strategy for hiring, marketing, and other key areas by explaining your plan to hire additional developers and salespeople and how you market your app to riders and drivers. Now we'll talk about the financials and use of funds. This is where you explain your current financial situation and how you plan to use the investment you're seeking. This section will include your revenue model, cash flow forecast, and any other financial information that's relevant. You also need to explain how you plan to use the investment to grow your business, such as hiring, marketing, or product development. You might explain how the investment will be used to expand to new cities, improve the app, and hire more salespeople. Try to practice your pitch and get feedback from others as much as possible before you present it to investors. Lesson 5. Preparing for tough questions. Now, what is due diligence? It's a process of investigating a company before making an investment. It typically involves looking at a company's financial statements, business model, intellectual property, and management team for any potential risks or red flags that could impact the value of the company. This is something you should be prepared for to avoid delays or issues down the line. There are a few key things you can do to prepare for due diligence, including gathering and organizing all your company's financial statements, contracts, and other relevant documents, preparing an investor deck that highlights your company's strengths and addresses any potential risks, getting your management team on the same page and making sure everyone is prepared to answer any questions from investors, and having a clear vision for your company's future and being able to articulate that vision to investors. The more prepared you are, the more likely the due diligence process will go smoothly and result in a successful investment. Remember to anticipate and prepare for tough questions that investors may ask during the due diligence process. Here are a few examples of tough questions investors commonly ask. What's your company's competitive advantage? What's your revenue model and how will you generate profits? What's your go-to market strategy? How will you handle challenges that arise? And what's your long-term vision for the company? It's important to be honest and transparent when answering these questions and to have well thought out answers that show you've considered all possibilities. Venture capital is an important source of funding for startups, but it's not without its challenges. It's important for you to be prepared and have a clear understanding of the VC funding process before you begin. Of course, you have the choice of learning as you go, but this can be very costly and time consuming. I know this is a lot to digest all at once, but with the right preparation, you can maximize your chances of success and secure the funding you need to grow and scale your business. Don't forget to like and subscribe to stay up to date on our latest videos and follow us on social media for more content and updates. Thanks for watching, and I'll see you guys next time.